Ladies and gentlemen, please welcome CEO of the Milken Institute, Michael Klowden.
Good morning. Oh, I got a fair response. Look to the table. Good morning.
Good morning.
Much better. Thank you. It's a great way to start out a warm way for what's really going to be, I think, a terrific 2 days. We're going to have for you a wonderful program. There are 1,000 of you that are going to be here. You're regional and global leaders. You represent well over 20 countries. And you're here to tackle some of the critical challenges that are going to impact and are impacting the future of the Asia-Pacific region. Now, you're going to have the opportunity to listen, discuss, and collaborate on today's top-of-mind and important issues that reflect a world in transition, ranging from medical and translational research, technological disruption, capital and financial market trends, geopolitical tensions, shifting demographics, and much more. Now, at the Milken Institute, our mission is to increase global prosperity by advancing collaborative solutions that widen access to capital, create jobs, and improve health. And we do this through our research and our written work, but also by creating platforms for leaders such as yourselves to have direct and in-depth discussions, and to encourage productive partnerships that forward actionable, effective policy solutions. That's one of the reasons you're here. You're here to work, not just to listen, but to engage in conversations and to come up and to think of things, to have new ideas, to listen to what you hear, listen critically, have discussions with your fellow attendees, and hopefully have those discussions not end here, but continue on. Because since establishing the Asia Center in Singapore in September of 2013, we've expanded the outreach of the Institute across the Asia-Pacific region. We've convened thousands of industry and thought leaders to tackle the issues that are most relevant to the region, such as healthcare, infrastructure, capital, and financial markets development and aging. As we celebrate our 5th year in Asia and our 5th Asia Summit, I'm proud to share that the Asia Center, under the very able leadership of Laura D'Alessi and her great team, have in the past 5 years organized these 5 Asia Summits, each one of which I think has been better than the last, and I know this year will be no different. We've hosted financial innovation labs and capital market development roundtables in 7 different countries throughout Asia. We've convened senior regional leaders roundtables in Singapore and in Hong Kong, bringing together Asia's most powerful business heads, government officials, and policymakers. We've grown our Young Leaders Circle network, inspiring the region's most promising young and philanthropic professionals and exposing them to the world's most influential thought leaders. And we've published data-driven practical research, much of which has stemmed from our financial innovation labs and the regional roundtables throughout the region that I mentioned before. Now, for the 5th Asia Summit, we have over 50 public panels and private sessions of engaging and in-depth discussions. This year's theme, A World in Transition, Preparing for the Future, of course, couldn't be more pertinent. We're obviously in a period of dramatic transition. Asia sits at the nexus of that. This region has become known for its innovation and disruption to the status quo, but how it responds to the significant challenges presented by this global transformation will affect the rest of the world for generations. So now is the time to prepare for the future and to unlock Asia's greatest potential. Each and every one of you sitting here today is a part of that potential to change. And with determination, you have the influence to shape the path forward. So it's only with people like you, that the Milken Institute can do our part to achieve our mission to advance global prosperity. There is another essential ingredient for us to do that, and that, of course, is the generosity of our sponsors. So I'd like to just take a moment very briefly now to list who they are.
The Milken Institute wishes to thank our underwriter, our sponsors, and our strategic partners for their support. Without their generosity, the Asia Summit would not be possible.
So join me in
thanking.
You're welcome. Join me in thanking them. And we will be listing them by name at lunch. You'll have a chance to thank them more properly then. So again, I want to thank you all for taking the time to be here today. We wish you a very productive and enjoyable Asia Summit. And now let's get on with our panel. So let me welcome the panel. Our moderator for the opening session, A World in Transition, What Matters for Asia, is Haslinda Amin, who's the anchor and chief international correspondent for Southeast Asia for Bloomberg Television. Please welcome her and the panel.
Oops.
Good morning. Thank you. Now we talk about the world being in transition. It's no different for Asia. We talk about the fourth industrial revolution, which is causing disruption, sometimes havoc across industries, not just finance, but education, healthcare, auto, you name it. On top of that, we have demographic shifts. It's no longer just about the millennials. It's about the graying population, them impacting growth, productivity. How do you tap the potential of the graying population? And the rise of the middle class, how they access information and services, that will dictate where businesses go from here. Now, all these things are happening at a time when there's greater volatility, not just in the markets, but also in trade relations. So the question really is, how do governments, how do companies navigate these challenges, and how do they, I guess, capitalize on the opportunities? Now, I'm really privileged to introduce our panelists this morning. Please welcome, to my left, Niham Choi, Korea Investment Corp CEO. Round of applause, please. Thank you. Ming Tan, Credit Ease CEO and Chairman. And no stranger to many of you, Ravi Menon, MAS Managing Director. Of course, the de facto central bank governor of Singapore. Gentlemen, thank you for being here. Now, when we talk about volatility, I want a broad overview of where we are right now. 10 years since the global financial crisis, is Asia in a better position to navigate the external shocks? We've seen what's been happening with emerging markets, the sell-off. It does seem that there is some sense of nervousness, but when you speak to market players, they say fundamentals are intact. Ravi.
Yeah. Well, Haslinda, that was a good segue into the current conjuncture, and I think you've put it well. The global economy is remarkably resilient right now in the face of quite significant uncertainties. Growth this year likely to be as good as last year's growth. And last year's growth, mind you, was the highest since the global financial crisis. So I think let's be clear about the baseline view. It continues to be a benign one in terms of global growth. There is, of course, a maturing of the cycle, and you can expect the next 12 to 18 months to be not quite as strong as the last 12 to 18 months, so going into 2019. Some of this, as I said, is to be expected. But I think there are two headwinds that are coming out of America and sweeping across the world that emerging Asian economies need to watch closely. And they can carry considerable risk if well not managed. First, increasing trade tensions. Second, tightening global financial conditions on the back of US monetary policy normalization. So these are the two things that present the greatest uncertainty and vulnerability and needs close watching. Now, if you take trade tensions, for instance, The tariffs that have been put in place so far are not in the data yet. And they are not likely to have a major impact. They're still small. Now, if the threatened tariffs, the tariffs that have been talked about, all proceed, then we're looking at maybe 0.5 percentage point of GDP growth of China and of America. And that will sweep down the supply chains and production networks across Asia and shave off growth in many of the small open economies in Asia. So that will have an impact, but it will not be disastrous because, end of the day, this is not a global trade war, but a series of trade conflicts and disputes and tariffs vis-a-vis one major economy in the world. So not to be trivialized, it will have an impact. But again, because so much of trade in the world occurs outside the United States and does not necessarily have a direct nexus to the United States, the impact should not be overblown. I think this is worth bearing in mind. Of course, things could get a lot worse from this point on, but that remains a tail risk for now. So, and if you look at what US accounts for, US trade accounts for 3% of global GDP. Not trivial, but not huge either. So I think that's one thing to bear in mind. The correct response to these escalating tariffs, I would suggest, is non-retaliation, and 2, to step up further trade liberalization with other countries. I think that's the best way to deal with this because that puts an end to the escalating cycle of a trade war and also creates new trade opportunities among other countries. And indeed, I think that's what Asia is doing. The TPP-11 is a good example. $10 trillion of GDP, that's the sum total of the economies involved in TPP-11. It's expected to be ratified early next year when it comes into, and then it'll come into force. And already you have 5 or 6 other countries waiting to join the TPP-11, which is a very good sign. So there is a trade creating effect to bring down barriers even further among other like-minded countries that I think we
Ravi,
should
I
push
just
on.
want to jump in here. You talk about how the right response is non-retaliation, yet we have heard from China it will retaliate
Yes.
and it will be tit for tat. So could the risk, could the impact be greater than most of us anticipate?
Indeed, if retaliation goes on in a series of tit-for-tat moves, the impact will be bigger. So what I'm suggesting is that you can actually stop it by not retaliating, because when you impose a tariff, there are 2 things that happen. You hurt your own economy and you hurt the other economy. So if you are subject to a unilateral tariff, the best response is actually not to retaliate. You absorb what has been hurt on you, but you do not further hurt yourself and the rest of the global trading system by imposing a tariff. Now, of course, that is from a purely economic point of view. In reality, countries do feel that they have to show retaliation. But what I'm suggesting is that the best response is either limit your retaliation, but more important is to open up more trade with other like-minded countries. And that is happening with many other countries now approaching one another to see if we can bring down barriers further, because what's at stake is the global trading system that has served us so well.
So a note of caution, don't be complacent, but there seems to be a disconnect in the market, right? The market versus the economy at this point in time. If you take a look at the markets in the US, it keeps testing new highs. Hinam, your thoughts on whether we're seeing this disconnect and how do you
First,
perceive it?
I'm going to respond to Levi's point on the further liberalization. I fully agree with that point. So in Asia, we are heavily dependent on external demand. So further liberalization is a necessary condition, also sufficient condition for our economic development. So TPP-11, Korea might be one of the waiting line. We are waiting line. Also, RCEP, we expedited to conclude the RCEP negotiation. Also, we try to strengthen, Korea try to strengthen economic cooperation with ASEAN countries. So it's a new economic policy agenda by new government. So I fully agree with that point. Regarding the emerging market volatility, Ravi mentioned about the risk factor. But let me overview what the emerging market status now. So Compared to 10 years ago, just to look at the emerging markets, I mean ASEAN countries, I think that we have more strong external sector compared to 10 years ago. Also, most countries already adopted the floating exchange rate system. So FX exchange rate adjusts the external shock. Also, many countries build up their own safety net. I mean bilateral safety net, multilateral safety net, global safety net. By having bilateral swap line, also ASEAN region, we have ASEAN +3 Chiang Mai initiative. So compared to 10 years ago, we think we are quite resilient in that sense. Also, few countries are mentioned very fragile in terms of their external debt and huge current account deficit, but many ASEAN countries adopted macroprudential measures to contain systemic risk, which is a good example to strengthen their economic fundamentals. So I can say Asia is quite resilient to external shock, and some tumors in certain countries, very country-specific issue, rather than I don't think the crisis will spread to whole EM countries.
Ning, coming from China, what's the perspective from Beijing, given that it is right smack in the center of this trade tension?
Yeah, we heard there will be more talks, right, this morning, and yeah, I think things keep changing, and in an uncertain world, we'd rather look for things that are certain, that are sure to come. So when you look at China, what is certain? We see that the China economy is powered by two very powerful growth engines. One is technology. The other is the middle class, looking for better education, better healthcare, better financial services, so on. So these two powerful engines are driving China's future growth. You see a slower growth rate, but actually the quality of growth is much better than before. I was in Xi'an like last week. The Xi'an government was promoting venture capital. You didn't quite see that a few years ago, because government term is just a few years, right? Like no more than 5 years. Venture capital is a very long-term thing, right? It's like 10 years, even longer than 10 years. So presumably, no one wanting to be promoted in government should promote venture capital, right? But there, the party chief and the mayor were with us whole day for venture capital. So I think that's a very good sign that people are doing the right things. So what we see is in China, 3 things are for sure. One is that people, families, businesses are going global. This trend is inevitable. We are here in Singapore. Actually, we came to Singapore 4 years ago in the path toward like being global company. Our clients, our business partners are global. Yeah, so this trend, I think, is very powerful. Chinese people, businesses are going global, nonstop. And another trend is that people are investing into the future. Manufacturing, real estate, export, import, so on. These traditional businesses have created tremendous wealth for China and the Chinese business leaders. But these traditional economy business leaders are investing in technology, investing in Industrial 4.0. they are investing into the future through VC, through angel investing, through wealth management vehicles. Yeah. And finally, what's happening in China is that the first generation, the elite, the entrepreneurs, are thinking about how to pass their wealth on to the next generation. This is a very profound opportunity for financial services professionals because like a vast amount of wealth has been created in just 1-2 decades, and now it should all go into the next generation hands because the first generation is in their 50th, 60th age, and their businesses need to also go to the next generation. So I think this is a very big opportunity for all of us in this room.
Ravi, Ning talked about how there's no stopping the new economy. In our conversation with Piyush Gupta of DBS, the rock star of DBS, I don't know whether he's here this morning, he talked about how the banking world is in the middle of a digital banking war. Your take on that and where you see the banking world, I guess, morphing to in the next 5 years or so?
Yeah. So I think banking's in a very interesting place right now. There's, of course, the phenomenon of non-bank players using fintech and other technologies to provide a variety of financial services, usually in very niche areas without going into the full scale of banking business. That obviously poses a challenge to the banks. But as I've said on many occasions, the banks are not sitting still. Just the last 2, 3, 4 years, almost every major global bank, and especially many of the banks in Asia, Asian banks, have been investing heavily in technology themselves and making themselves more digital, providing a range of services through the mobile device, through the internet, and making it as seamless as possible. And so I think we're seeing a very interesting set of competitive dynamics going on that is going to raise this quality of banking. The other interesting phenomenon is the way in which mobile banking is now being used to penetrate unbanked sectors in Asia. Despite all the high growth and development in Asia, just in Southeast Asia alone, about 170 million people remain unbanked, unreachable. And the mobile device is doing that, is reaching out to them to offer basic services like payments, deposits, insurance, personal financial services. And for small SMEs, simple loans, factoring, and so on. I think this is being done both by fintech firms as well as by banks. And what you're also seeing is a lot of collaboration, with banks buying up fintech firms, entering joint venture collaborations with fintech firms, because you want to leverage off their nimbleness and their innovative designs, but leverage off the trust capital that banks have built up and the wide customer base that banks have. So I think we're in a very interesting phase, and I would not say that all banks will do this well, but those who invest in technology, those who invest in innovation, those who train their workers and adopt these new methods are going to do much better.
But I'm just wondering whether banks are embracing technology fast enough, because we talk about fintech, there's also techfin, and the likes of your Amazon and your Facebook encroaching into that space. I mean, it's complicated.
It is, but they also know that if they are encroaching into banking space, they would need to then be regulated like banks. And once you touch deposits...
Do you see that happening?
I think in most jurisdictions, if you carry out financial activities, you would need a license to carry them out. So if you carry out payment services, you need a license above a certain threshold. If you are offering financial advice through robo-advisory services, then you need to be licensed as a financial advisor. If you're operating a small wallet, fine. But if your wallet size grows and you are taking large deposits, then the float has to be protected. Or you would have to be regulated as a bank, which means meeting capital adequacy, liquidity ratios, leverage ratios, and the like. So I think this is an evolving space. Most of them are below the threshold levels that trigger licensing. But as they grow bigger, they will have to be licensed because they will become systemically more important. And a regulator has to regulate them for the same reasons that they regulate banks. in which case the playing field is level again.
Hinam, it's quite different in Korea where the regulators are perhaps not, I guess, up to speed, for lack of a better expression.
Yes, in Korea, there are hot debate. How can the government regulator allow fin companies to do finance business? As you mentioned, that in the past we talk about fintech, but now we are talking about techfin. So if you look at the banking sector, they just what they did during last 10 years is just the internet banking business. They upgrade their internet banking service, but they might fail to provide more customized service, need-based service to customers. So small techfin companies, they try to make room for their business. But unfortunately, there is a hot debate is going on about how government regulate this business or not, how much, whether we should allow major shareholder of that kind of business. In Korea, the industrial business cannot control banking business. There is a quite separation firewall. So how about techfin business cases? Should we allow major industrial shareholders can control techfin companies? We are still debating on that issues. So there might be, once we reach the consensus, there might be some provide good momentum to develop fintech or techfin industry.
Ning, what's the next phase of fintech for you? You're a fintech company.
Yeah.
What's the next phase, and how do you deal with regulators? On the one hand, we have someone like Ravi Menon in Singapore, who's pretty progressive and open to see where this takes us. On the other hand, you have countries like Korea, which are pretty resistant to change. How do you deal with regulators?
We are just in the middle. We have a balanced system. Well, I think we've been around for 12 years and as a fintech leader in China and also investing globally. So we have good exposure. In the past 3 years, we've made over 30 investments in fintech in the United States, becoming the most active fintech investor with the corporate background in the US. We also have made investments in Southeast Asia, including Singapore, India, and also Europe. And I think globally, fintech is a powerful trend, meaning like we utilize technology to make financial services accessible. Giving you some examples, in China, we work with Amazon. Yeah, there are small merchants from East China, South China, selling on Amazon platform to the outside world. And they have no tangible assets. Traditional banking system cannot serve them. But they have intangible digital assets, their operational data, transactional data. So we get that through Amazon, through PayPal, eBay, so on. So we are able to assess their credit worthiness real time. Give you another example, like China's rural sector is becoming more and more automated. Yeah, so farmers in China do like drone. Yeah, drones are flying all over rural China to kill pests, right? And also driverless vehicles for harvesting, so on. But farmers cannot afford this equipment. So 5 years ago, we invented this new financial inclusion model, which is micro leasing. So we lease equipment to farmers, right? Like after a couple of years, they can just own this equipment. And then we extended this interesting model to what eventually got called livestock leasing. So we started to lease cows. So today we work with over 200 cow farms in China. We own over 60,000 cows. Yeah, but what's interesting is that all the cows are technology equipped. So we know how they do. If they need help, we go help them, right? And we also provide cow insurance in the case, like, right? Because that's our cow, we should take care of them, right? So these examples show you, how finance empowered by technology can really help grassroots, rural China, like small businesses, so on. In the past, the traditional financial system, banking system, couldn't cover very well.
So where should smart money be?
Well,
I mean, you look at all the trends, you meet all the companies, you see what's out there. Where should smart money go to?
yeah, actually, another thing we see is that if you go to China for investment, in the past 10, 12 years, probably you would have made more money investing in 2C companies, like social networking, gaming, so on. But today, you see more and more like 2B companies, like enterprise software, enterprise SaaS, so on. Because Chinese businesses, Chinese entrepreneurs want to be more agile, want to be more efficient. So such like, enterprise software business is going to do very well in China, technology driven. We see that trend very clearly because in the past, you as a business owner would not worry too much about top line growth, right? Market is big, like you do land grab, so on. So efficiency management is not on top of your agenda. But now economy is slowing down, competition going up. So you really care about how efficient you do the land grab, so on. So enterprise SaaS, enterprise software will be very big in China because like in the US, we know like enterprise software to B business is as big, as valuable as to C business. But that hasn't been the case in China. But in the coming decade, we see more and more to B business growth tremendously.
Hinam, is that convincing enough for KIC to be putting more investments into tech? Because KIC has not really looked into tech, unlike sovereign wealth funds like GIC, which look to tech since it was founded.
Yes, we try to increase our exposure on venture capital, but we are still early stage. So we invested venture capital indirectly through fund of funds cases, but venture capital we are not quite sure about how can it can be successful. But other area like TMT, technology, media, and telecommunication, we did huge investment in US, in Europe, in Asia. So now you try to move to big industry to more small size, early stage of the industry, venture capital. So still we are early stage.
Ravi, being a regulator, this one's for you. I mean, we've often talked about how, technology 4.0, but policy 1.0. How do you bridge that gap? What does it take? And if you're a regulator, what's the first thing you need to do?
First thing you need to do is to watch the technology closely, try to understand it. Don't rush to regulate. Let it proliferate, but keep a close eye on risks. Keep a close eye on risks and vulnerabilities. There are various...
What kind of risks and vulnerabilities do you look for?
Well, the first is systemic. And right now, I don't see that. Systemic risks are risks that have an impact across the entire financial system, affecting large numbers of players. Today, most of what we see in the fintech space doesn't quite pose that kind of risk. And this is indeed the conclusion that the Financial Stability Board has also come to, that there are no large systemic risks posed by fintech firms or fintech activities. Now, because most of them are in the unregulated space, the things I would focus on are risks associated with technology, say cybersecurity risks. Yeah. Those bear watching. Second, all the risks associated with money laundering, potential financing of terrorism, because know your customer rules are something that banks and regulated financial institutions pay a lot of attention to. And this needs to be also done in the unregulated space. So these are the two things that we've been focused on, where if a player gets large enough, we would expect these players to have in place safeguards on cyber risks and money laundering risks. The other risks will then depend on the specific activity they play. And I think to your question on how should regulation respond, I think increasingly regulation should start focusing on activities rather than entities. If they're carrying out a similar activity to a regulated financial institution, then they should be subject to the same requirements and standards. I think that's only fair. I think that's to protect against risks. But you don't have to impose the full load of regulation on them because they're not carrying out other activities. So be it for payments, you have to look at what kinds of payment activities they're undertaking. If it's advisory services, what kind of financial advisory services they're doing. Are they issuing securities? So ICOs is a good example. If the ICO does not amount to a promise of a return, it does not meet the qualification of a security, and therefore they will not be regulated as securities. But if they do, if they have a notion of repaying principal or some prospect of a return depending on the performance of the firm, then the Securities and Futures Act comes in. So I think we need to take a sophisticated activity-based approach and rather than taking a blanket approach towards all technologies.
Can there be a more coordinated approach by all regulators so that, as a fintech company, as a startup, I know what the rules are wherever I am?
Yeah, so that is something that regulators are increasingly talking to one another. And we've got a range of fintech agreements with many other regulators, and we exchange views and experiences. But this is early days. It took a long while for the world, the regulators of the world to come together to put together the Basel rules for capital, for liquidity, and so on. And this is still very nascent space. So it's going to take a while before there is some kind of common approach adopted across regulators. But I think we are getting there with lots of collaboration and exchanges of views. And you should also remember that the fintech space in each country is very different. So it's also harder to come up with a common approach.
Let me add another important risk with regard to fintech or artificial intelligence. I think usually fintech is applied based on the analyzing big data. Then big data issue also raise the issue of the privacy issues. So I think it's not a burden on financial regulator, but in general, you have to care about the privacy issues when using big data. So in the past, we can say, I know what you did last summer. Now people know, I know what you are doing now. But in the near future, I know what we will do tomorrow. So in that sense, we really care about the privacy issues when using technology in financial sector, not only in financial sector, but also other areas. Yeah.
Ning, what would you like to see from the regulator? What should they be doing? What shouldn't they be doing?
Yeah, I think privacy issues like related to data, like is one. In the past, the Chinese consumers, have been very willing to share information to an extreme, actually. But I think in the future, they will become more aware that this is a very serious issue. And also, I think infrastructure development is particularly important for China. After 12 years, like fintech development, like say marketplace lending, non-bank financing, so on, we still don't have a well-established credit bureau system. Yeah, there have been a lot of efforts along that line, and I very much hope that in the coming 12 to 18 months, there will be like fully functional credit bureau, because that's really key to healthy fintech industry. And also, we are seeing that the regulatory framework for China fintech is becoming more and more like on the ground and being implemented, which is also very good, because without a robust regulatory framework regime, bad guys can do bad things, also utilizing technology. Yeah, technology is actually a neutral tool, right? Good people use it to do good things, but the bad people can do bad things. Yeah, so I think regulation is very much necessary for fintech innovation. In some cases, people say, hey, you know, regulators just want to kill innovation. I don't think so. Yeah, I think smart regulation is very much necessary. Yeah.
We talked about how the middle class is on the rise. How do companies and governments capitalize on this? I'm going to ask Ning to start off because, I mean, China is a case in point.
Yeah, I think for middle class rising, like, China is moving from like low quality, like marketplace society to a high quality, society or consumption marketplace. Because in the past, the people worried about not having access to things, but now they are asking for high quality things, right? Like you may have heard that Chinese consumers, middle class, fly to Japan for some house appliance and go to Hong Kong for milk products, so on, because quality is really an issue for China. So like yesterday, a Chinese entrepreneur, one of our clients who came to Singapore for this event, who's sitting in the audience, was telling me that he really wants to kind of build some like a domestic brand, that is trustworthy. And that is really, quality oriented as opposed to just volume, scale, so on. I think this is very important for China middle class because, we are so hungry for high quality education. We are so hungry for abundant and high quality healthcare like resources, right? The society is aging and we just don't have those like great resources available to us. So I think this is a huge, huge business opportunity for investor community.
Does it change anything in terms of regulation, given that the middle class is pretty much accessing information, services in a very different way now?
Yeah, I think Ning's brought up a very important point, and this goes back to the earlier discussion about Asia's prospects. If you discount the conjunctural challenges that we just spoke about earlier on, trade or financial markets tightening and so on, conditions tightening, the underlying growth story in Asia is intact. That's bad. Asia, if you just take the ASEAN, I mean, Ning spoke a lot about China, but this is right across Asia, Southeast Asia and South Asia. In Southeast Asia, growth 5 to 6% per annum for the next 5 years. These are the official forecasts. Eastern Europe, 3.3. Latin America, 2.8. This is the most dynamic part of the world. And a good part of it has to do with 3 trends. One is the rising middle class that Ning spoke about. This is a huge phenomenon. With a rising middle class, there will be demand for a whole range of goods and services that were much less demanded previously. The consumption basket changes dramatically towards more tourism, towards modern services like financial services, like insurance services, professional services, education, healthcare. These are the things that economists say have high income elasticity, meaning when your income increases, you demand a lot more of these things rather than food and clothing and other basic essentials. This shift has been underpinning domestic demand growth across Asia and intra-Asian trade to meet final Asian demand, whether it's in large countries like China or Indonesia, or even the smaller countries, but who are in middle income status. So this is a huge phenomenon. The second is urbanization. Urbanization brings with it a whole range of demand for services of a different kind. Infrastructure investment is a big story with growing urbanization. And then there is the integration of these markets that's ongoing, which I also alluded to earlier on, whether it's through the TPP-11 or the RCEP, which will create the largest trading bloc in the world. So I think this growth story in Asia remains intact, and that's something that long-term investors continue to bear in mind, to stay invested in these economies.
You know?
Yes, the rise of middle class in China actually provides good business opportunity to Korea, because currently our export to China, 25% of our export goes to China, mostly intermediate goods and parts. So nowadays, more Chinese request consumption goods made in Korea. So that is another area Korea can expand our business relations in China. So not only Korea, but also other countries in Asia. The rise of middle class in China provides, as Manon just mentioned, that increase intra-Asia trade business relationship. Also, that's gonna, China gonna more depend on internal demand rather than external demand. So that is good for our Asia future direction. Yeah.
Is that
Let me add one point. I think it's also very important. Actually, Chinese middle-class consumers are quite challenged these days. Yeah, because, for example, like, in the past, they could rely on, like, banks, traditional financial institutions, like, for investment products, right? And usually these products are guaranteed return, and quite short-termed, half a year, 1 year, 2 years, like, So that's dream product, right? Like relatively high return, guaranteed by the government, no risk, right? And but it doesn't exist anymore. It shouldn't have existed, actually, in the first place, but now they have to really think about their safety net, right? Like now people live longer, like after their retirement, how to take care of themselves, and now how to take care of their parents, kids, so on. So financial services investment is really changing landscape in China, because in the past, the people really don't quite have this long-term investing concept. Yeah, so you talk about like, investing in 10 years time, like holding your portfolio for 20, 30 years, no way. People don't like that at all. People don't trust the system. And if you look at Chinese like stock market, like it's very speculative. Yeah, so how to change really investor mentality? That's like a key thing. These days, like the China financial services market is being made wide open to outside like foreign companies, right? Like 51% control is allowed, or in some sectors, 100% control is allowed. But I don't think a foreign player should go into China, do kind of low-hanging fruits. Low-hanging fruits are gone. Yeah, they just have to be committed to the future, really doing the hard things like investor education, like changing people's mentality from short-term to long-term, from fixed income, government guaranteed, to really like a capital market, stock price fluctuating, but you should bear that in mind while investing long-term, so on. So I think it's really a different ballgame for foreign players to really compete in China.
So Ravi, will there still be banks in the future?
Oh yes, there will still be banks, but they will look very different from what they do today. I think the competition really is about the mind share of the consumer and serving consumers' needs in a more comprehensive and seamless manner. So again, people don't desire a housing loan for its own sake. They desire a house. The loan is a financing towards that. The insurance is a way to protect your asset. So everything else is built around those things. And I think banks will increasingly have to compete to provide a range of broader services to consumers, of which financing and banking is integrated as part of a seamless whole. And this is what the platform companies are doing. You look at a firm like a startup like, or a fintech like Gojek in Indonesia, started with ride-hailing services, transportation. And then they realize that they have the mind share of the consumer is sitting on the platform. I can also offer other services, courier services, home services, and spa appointments. There are a whole lot of things that you can add on and make the consumer experience a delightful one. And this is happening with both banks and non-banks. And I think at the end of the day, this is how technology is helping to increase the convenience of the customer, increase efficiency in the way the economy functions. And I think all this is good. We just have to make sure that there are good regulations in place to control the risks associated with some of these activities. We spoke about privacy and on data, that is important. And this will be one of the central challenges for all societies, because it pulls in two different directions. The real value from a lot of these technologies comes with the ability to process and aggregate large amounts of data together to draw insights and to offer customized solutions. At the same time, this aggregation of data and this access to data presents privacy issues. So we need a framework in place that allows this to be done in a responsible fashion with customer consent and customer knowledge of what the data is being used for, and at the same time to allow the responsible use of data aggregation and drawing of data analytics and insights to deliver superior outcomes. I think if societies around the world can get this equation right, there's a lot of benefit to be gained from some of these new technologies.
We have about 8 minutes left, and I have a couple of questions. First, for all three speakers, what do you think is the next big thing? Hino.
What do you mean by the big thing?
Whether in tech, whether in any, you can choose whether it's in healthcare, auto. What do you think is the next big thing?
Next big thing, I think.
That investors should be paying attention to? Mm-hmm. Do you want some time? We can start winning first?
Yeah.
Well, we talked about those like trends, right? Like they are certain, they are coming for sure. So I think I would strongly encourage all of us to focus on what's certain in an uncertain world. Yeah, for example, like, we talked about Chinese investors, like people, businesses going global. That's certain. So what can we do about that? China is developing technology, like Chinese investors are investing for the future into technology. That's also a very big opportunity. Also inheritance, succession planning, passing their businesses, their value systems, their wealth to the next generation, huge business opportunity. Aging for China, huge business opportunity, like middle class demands in different service sectors. So I think if we place bets in these sectors, they are very safe, very safe. Like, but you have to give it a long term. So like 10 years, 20 years. So I think we will do very well if we focus on those certain things, trends, and be very patient, really, have long-term commitment.
The next big thing, I think, even though we are in Asia, the aging population is really a big thing we have to prepare in the near future, not the long future. As you might see, the birth rate in Korea nowadays close to 1, maybe below 1. And the aging population in China already peaked, but their GDP of around 20% of United States. Korea 60%. So maybe in the future, if you cannot handle these aging issues, China might be in middle income trap. So how can you handle these aging issues? Maybe big thing we have to think about. But in terms of investment theme, so KIC nowadays we try to look at these area of the sector related to aging, like we try to invest in senior housing projects, also healthcare project, maybe closely related to aging issues, but I think we need to more tackle on how can you handle these aging issues. But I have no idea, but immigration may be one way, but it's very politically, culturally very difficult agenda. So as a policy agenda or industrial leader or the regulator, we have to think about how to tackle these aging issues.
Ravi?
Well, central bankers not quite in the business of the next big thing. And all the things that have been mentioned, I fully agree with. Technology, big data analytics, urbanization, rise of the middle class, demographics, population aging. I think these are all going to be major themes as we go forward. I think let's not forget the old things that remain absolutely important, whether it's for government policy or for investment strategies. And these are the fundamentals. Sound macro fundamentals remain absolutely key. Everything that we've said here about Asia, this has been generally a very uplifting tone. And I do believe in much of this. This is the baseline view. But it all hinges on two things: keeping the system open, trading systems, investment regimes open, integration, that's absolutely critical. None of this will come to pass if that collapses. Second, sound macro fundamentals. Mm-hmm. We didn't talk about debt and leverage at all in this discussion. Keeping that under control is absolutely important. Asia has done that reasonably well. It needs to do better going forward.
But emerging markets are not doing so well. Most of them are having debt 10 to 50% to GDP, which is very high. So how concerned are you about it? And do you see governments?
Yes. So I think it's very unfortunate that the investment community has an asset class called emerging markets. There is no such thing. Mm-hmm. The emerging markets includes China all the way to countries in Eastern Europe and Latin America. They are so different. We don't treat advanced economies that way. I would make a pitch for Asian emerging economies. Emerging economies in Asia are, I think, in a better place than emerging markets elsewhere, generally. And it goes back to what I mentioned earlier, the fundamentals. Growth is good. Inflation is low. Buffers are strong. Central bank reserves, bank capital adequacy, supervision of the financial institutions, external debt ratios, right? Mm-hmm. It is not a sin to have a current account deficit if you're a developing country. Singapore had current account deficits of 20% of GDP in its first 10 to 20 years of independence. It's a question of what? It only means that you're investing more than you're saving. I think the question then is, are you investing in the right things? And Asia generally is doing well on that front. So I think...
Why then is a market like Indonesia getting battered because of its current account deficit?
Indonesia is a very good example. GDP growth, 5%. Very respectable. Inflation is 3.5%. This is better than what Indonesia has had historically. Fiscal deficit, 2% of GDP. How many countries in the world have much larger fiscal deficits than that and get on? Current account, yes, has deteriorated the last couple of years, but at 3.5% of GDP, not unduly alarming. External debt or total debt to GDP ratio, 30%. Many other countries have much larger debt ratios. So I think this is a country which has got sound fundamentals, has been doing the right things by way of policy response. The central bank has hiked interest rates to keep up with foreign rates. The government is enhanced revenue collection a great deal and has also now looked to postponing import-intensive infrastructure investments. Mm-hmm. This is a country that's doing the right things, that has got good fundamentals, but yes, is exposed to global markets. And when global markets are responding to rate normalization and an equilibrating of global financial conditions, some of these volatilities to be expected. I think as the months and quarters go ahead and investors become more discerning, they will make these differentiation across emerging market economies. So I do expect some volatility in emerging market economies, including in Asia. Let's not be too sanguine about this. This is part of the adjustment that needs to take place, given what has happened in the last 10 years of large inflows into this part of the world. But when this adjustment runs its course, I think there will be better differentiation and discernment among the emerging economies. And I would make a pitch that those in Asia are doing well, and countries like Indonesia are doing the right things and will get through.
And on that very optimistic note, ladies and gentlemen, please do join me in thanking our panelists today. Thank you for being here.